Hey everyone, welcome to Know the Risk 101. My name is Emily Bradford.
And I'm Walter Jackson.
Today we're going to talk about something that everyone loves to talk about, life insurance. Even though it's an intense and emotional conversation, it's something that everyone should have. So here's the age-old question. Do I need life insurance? Well, if you fall into any one of these buckets, then the answer is a massive yes. Do you own a home? Do you finance a car? Do you have student loans? Do you have at least one person who cares about you? Are you married? Do you have kids? Does anyone rely on you financially? Would you like to be properly buried? Do you have any debt whatsoever? Would you like to make sure your kids or spouse are able to go to schools or training? Do you have at least one person you care about? Does anyone live with you? Do you have grandchildren? Could you at some point have the slightest risk of developing a medical condition? Could you at some point become disabled and unable to work? Do you breathe oxygen? So I don't think I missed anyone. So the answer is yes, everyone needs a life insurance. Let me repeat this again. Unless you are a hermit who built a cave in the side of Mount Washington, fishes out of the river, doesn't have any connection to the outside world, or doesn't really care about what happens to you, you need life insurance.
That brings us to the question, what's the risk? The risk is you're going to die. There, I said it. It happens to all of us. Nothing we can do about it. But it's a touchy and very emotional subject for a lot of people. When we come back, we're going to talk about life insurance, the different kinds of life insurance, and we're going to help you avoid the risk of dying without the proper protection and leaving your family to pick up the pieces.
So welcome back. So throughout this show, Walt and I are going to discuss the different types of life insurance and of course then answer questions that came in from you guys through our social media pages. So to start, there are two basic things that affect life insurance: age and medical condition. So it's best to get it earlier in life because usually you're in better health younger than older. So you're kind of killing two birds with one stone. There's a type of life policy that everyone knows. It's work life insurance. So I hear the statement every day, oh, I'm okay, I have life insurance through work. This is usually the point where I start to bang my head off my desk until I forget that I even heard that statement. Don't get me wrong, I have insurance through work as well, but that's not the only life insurance I do have. And it's a good start to covering the needs you have. Again, good start. Because work policies can usually vary by the type they are. Typically, they're term policies. We'll dig deeper into what term policies in a little later in the show. But usually your work policy is an annual renewable term, which it changes price every year. Hint, because your age goes up every year. Or is a policy where the price stays the same until you retire. So what happens when you retire? There's a couple things that can happen with your policy. One, they'll make you convert it if you want to keep it. And since you're an X amount of years older, your premium can go up 3 times, 4 times, 5 times. It could go up a lot more than what you were paying. Or the death benefit decreases every year after you retire. So when it comes time to use it, you don't have enough to cover everything you do. Or the policy might disappear completely and leave you without any insurance. So I found 2 good articles online that talk more about how work versus personally owned insurance kind of deals with each other. And we posted the links on our Facebook page for you to look at later. And we also posted a link about an article, a recent case, where a girl who was 27 years old died, and she had about $200,000 worth of student loans. And now her grieving family, parents, are left paying that behind now for her because they co-signed. Kind of a scary thought and situation, but it does happen out there.
It is scary.
Yeah. So let's dig deep in the 2 basic terms of life insurance: term and whole. Term insurance provides coverage for a fixed payment over a certain amount of years. Usually this could be 10, 20, or 30 years. and is usually the most inexpensive type of life insurance, which means that over that time period when it runs out, so does coverage. Some companies do give you the benefit of converting it into a permanent, some don't. But the good reason to buy this insurance is to cover life needs that usually disappear in 10, 20, or 30 years, such as mortgages, student loans, car payments, any other debt, putting your kids through college, etc. So if somebody dies in that time frame, then that money is available to at least cover those bigger debts, like I mentioned. But why keep paying for $400,000 in coverage when hopefully that debt disappears? But be careful with term insurance, because again, it disappears and you can outlive it. And if your term policy is through a company that lets you convert it, sometimes the premium then is a lot higher when converting, because again, you're that much older. It's that simple, guys. So it's good to have a mixture of term and permanent products so you aren't leaving any gaps in coverage, and again, you're not overpaying. Walt?
All right. I guess that leaves me with whole life insurance, the more complicated of the two.
That's why I gave it to you.
All right. Emily just discussed term. It lasts for a specified amount of time, and then it's done, or you end up renewing it every year, paying a little bit more every year. Whole life is different because it's designed to last for, guess what, your whole life. That's why they named it whole life insurance. It's usually more expensive than term coverage, and there's a reason for that. Whole life coverage usually builds a cash value, and that cash value goes up over the years as you continue to make your payments on the policy. So a policy that has a cash value of $0 on day one may have $5, $6, $7, $20, $100,000 cash value later on. That's one of the main reasons that it costs so much more, or not so much more, but it does cost more than term insurance, depending on when you buy it. Again, age is a big factor. You may be able to take loans against your cash value. That's another benefit of having a whole life policy. You can't do that with a term policy, and once you have that cash value built up, that's your money, and in most cases you can take a loan against that. Sometimes there will be penalties or tax implications involved, and in many cases you'll have a minimum amount that you have to leave in your cash value, but for the most part you've got the cash value there available if you need it. If you don't make payments on a term policy, it's gone. With a whole life policy, since you're making payments and you're building cash value, there's still going to be something there. So you're not going to look at a situation where you don't have any insurance. Now, that can be kind of tricky because if you've paid into it and you have $10,000 of value and then you stop making payments, the insurance company is obviously not going to honor the entire amount that you were making payments for because you stopped making payments. But what they may do is say, you've made $10,000 worth of payments, we'll take that amount and we'll buy you a policy that $10,000 would finance. So it's not as dangerous as term coverage because you do have that little bit of a safety net. Many policies will let you make additional payments when you're dealing with the whole life policy. So if you hit the lottery or you get a great bonus at work, you can add to that policy. That increases your death benefit. The death benefit is also called a face value or the death payout. But being able to continually add money to that you hadn't planned on, but based on circumstances, that'll get you a higher amount of coverage, and that will leave your family that much better off when the unfortunate happens. Also, most insurance companies, well, mutual companies in particular, and this is something where you'll need to check into the insurance company that you're insuring with, but there's two types of insurance companies. There's stock insurance companies and mutual insurance companies. Mutual insurance companies are owned by the policyholders. There's no shareholders. And they have a decision every year that they can declare a dividend or a contract credit. That's yours. If you have a policy with them, that is yours. And you can choose to do with that one of several different things. You can use it to buy more insurance coverage. That's called paid up additions. You can take a cash out, which probably won't be much of a cash out, but you have the option to do that. Sometimes you can buy smaller term policies that'll last a year, But there's different options that you have with the cash value that you're building up, and you're also getting the interest and then the dividends or contract credits that come on top of that. There's also different payment options. With the term policy, you pretty much set your payment at the beginning, and that's what your payment is all the way up until the end of the term. With whole life insurance, there's a monthly payment option or an annual payment option. You have a set payment, but you're making the same payment either every month or every year. You can also decide to pay the policy off in 20 years. It's called a 20-pay life policy. So if you buy a policy on a newborn, by the time they're 20 years old, their life insurance is completely paid for. No other payments have to be made. You can pay until a certain age. So if you're 30 and you want to pay until you're 65, your payments will be factored considering that. And once you turn 65, you're done paying and you have a paid off life insurance policy. And then there's single payment. That is, if you have the money in the bank that you can afford to just make a single payment, that usually gives you the best insurance to payment ratio. I was working on a case a few days ago, and just doing straight payments, the gentleman was looking at a 1-to-3 payoff ratio. So $30,000 was what he was going to put in for $100,000. But making a one-time payment of $20,000 would give him $98,000 in coverage. So that's a 5-to-1 ratio. So if you have the extra income and you can make that decision and make that payment, that's a good option. You can always still add more money to that to add coverage if you like to. You can outlive your term policy. Like we said, it's 10 years, 20 years, 30 years. That's typically it. Or there's 1-year term policies. With the whole life policy, you cannot outlive it. It's coverage for life. So once you get it, you've at least got that promise made to have a payoff when you eventually die. Since it's permanent, you can buy whole life in increments, and this is an important point, I think, because not everybody can afford all the insurance they need right away. You might need $350,000 of insurance. That's just based on what your debts are, your liabilities, loans, all those things. Having something is better than having nothing. So rather than just having nothing and waiting until you can afford $350,000, you can start with $25,000. You can start with $50,000. But once you do that, you've got a permanent product. It's not gonna cease after a specific time frame. Unlike term, which you can only buy until age 70, whole life, most companies will let you buy all the way up until the age of 80. That's a rare instance where you have somebody between the ages of 70 and 80 and they decide to buy life insurance, but you can buy it up to age 80 with many insurance companies. That's not a guarantee that everybody will offer that, but if you're 75 and you need to get insurance, be prepared to pay probably a hefty premium, but a whole life policy will let you purchase up until age 80. Emily?
Just to kind of piggyback off what you were saying, I was working with a case. It was actually my cousin, and he's a couple months old, newborn baby, and we wrote 20-pay whole life. It is very inexpensive. I think we calculated it that it was cheaper than a pack of diapers.
$24.95.
Yeah,
$24.95 was the cost of the diapers,
yeah.
And I think you said the premium was $18.
Yeah, and his parents will be able to hand him a life policy for the rest of his life at age 20, paid off. And every 5 years, for a couple increments, he'll be able to add more if he wants to, but it's there. And that's one of the things that I think is really important is they're pretty much handing him a guarantee of insurability for the rest of his life. So I think it's really cool when cases come about like that where we can make sure that people are covered regardless if they're 14 days old or 80 if they need it, or to the day they die. So
especially, I'm sorry, I don't mean to step on your foot, but especially given the fact that, in America, childhood diabetes is on the rise, and there's so many things that are popping up now. Buying that policy for a 3-month-old guarantees their insurability. So if something does happen later, if they have a heart problem when they're 13, or they get a concussion, playing sports when they're in high school, or if they develop diabetes, things like that, they still have that guaranteed insurability. So they've got some insurance in place, at the very least for burial expenses, but to take care of debts and things like that after. after they're gone.
Yeah, I think it's very important. Life insurance, I know myself and Walt are very passionate about. So if you have any questions or want to talk to us, feel free to give us a call, because we love talking about kind of life insurance and at least covering, because like you said, it's guaranteeing people insurability for life, and that's the most rewarding for us. That's why we do this, is to make sure that we really take care of people. So
absolutely.
Want to get into some questions? So one of the questions we got in is, when should you buy life insurance? Well, like I said earlier, the sooner the better. Age is a huge thing with rates on all companies, all kind of policies. So the sooner you can get it, the better it is. It locks in that age and that rate. Also, again, typically, you don't have a lot of medical issues when you're younger. Even just with getting old age, certain things happen and medications happen. So the less of that, the better the rate's going to be for you to lock in. But again, you want to take into budget. So say you do have that $3,000, or $300,000 need, but you can't, pay for that right now. Putting a plan together, because again, like I said, with my cousin's policies, we locked that in. So if a medical issue does come up in the future, it's not going to affect anything. You can still buy more insurance, and you're locked into that. So simple, the sooner the better with life insurance. Even if it's small at first, you can build a plan to cover your need.
How old does someone have to be to get insurance?
14 days old is, which is crazy. 2 weeks old is the soonest we can write a policy on somebody. So as soon as they come back from the hospital and get settled in, we can go in there.
All right. My first question is from Jennifer from Bethel Park. Thank you, Jennifer, for writing in. How do you know how much insurance you need? If I could figure out an easy answer for that, we'd all be millionaires. There's a lot of factors. What is your income? What is your debt? Do you have student loans? Are you married? Do you have a kennel of dogs in the back that need cared for when you're gone? There's many different factors. The thing about life is those things change. So your need now may not be the same as it is 20 years from now. I mean, if you have a mortgage now, your need may be to have a specified amount for your burial expenses and kids' college funds and things like that, but then you also need coverage for the house. You don't want to leave your spouse with that mortgage payment looming over them. So you really need to sit down and have a needs analysis done, because there's no cut and dry answer. I mean, everybody needs $1 million of insurance. That would be a catch-all for everything, but that's just not realistic. So for yourself, I would say give us a call, or if you deal with someone already, sit down and have a needs analysis, because that's going to get all the questions answered so that you can get to what your need is, and from there you can get to an action plan to put that coverage into place. That also, another factor you want to consider is what kind of insurance are you getting. I mean, are you getting term insurance? Are you getting whole life insurance? Are you getting a mixture of both? We typically recommend a mixture of both, just because, like I said, some expenses go away. Your mortgage is 30 years, and when that's gone, it's gone, and you're not going to owe as much 20 years from now as you owe now on that mortgage. So, how much you get is variable, and what type you get and how long you get it for, those are all variables. So I hate to give you a non-answer, but that's really there's no $50,000 answer or just a straight answer for that. So if you are interested in insurance, life insurance for yourself, talk to an agent and get your needs analyzed.
That brings up a good point where I hate when people go online and say,
Absolutely.
"Oh, those commercials, for $50,000, click here for $12." You don't know that covers. I mean, it might be enough for you, it might not be. So again, talk to somebody, or at least if you don't want to talk to somebody, go at home and write out what your debts are, what liquid assets you have, what you want to leave behind for your kids, burial. Write it all out and try to at least yourself come to a number. It's better than a one click and okay, I'm covered, because you don't know. So that's a big point. I just wanted to piggyback off of that.
Would you trust your computer to babysit your children or to take care of them for the rest of your life?
My cat? No. No.
And that's kind of my point. I mean, sure, you can go online and buy just about anything. I bought this suit, on Amazon. That's a joke. But how do you know how much insurance you need? And just going online and having, stars around $50,000, that sounds good, it looks good, just go ahead and click on it and buy it. That's easy to do, but that's more than likely not what your need is. So
yeah. Or what type of policy you need. Maybe $50,000 is all you do need, but it's a term and it's done in 5 years and crap again, you're going to be 5 years older. So it's a good question.
Yeah.
My turn?
Your turn.
So another question I got was, do my kids need life insurance? So with the example I gave before with my cousin, yes, kids need life insurance because obviously the main factor is making sure the parents are protected, because if they would die suddenly, then the kids would need something to take on the house, make sure they're okay, things of that nature. But my biggest thing with kids' life insurance is you want to make sure at least they have, burial costs taken care of. And that's something that at least grandparents or parents alike can make sure they give it as a gift to them in case something did happen. Obviously, they don't have mortgages, things like that. But again, the big part of it is guaranteeing their insurability. Hopefully when they're newborn, they don't have any kind of complications or get any through life, but it happens. Somebody doesn't just wake up one day and say, oh, I want to have a heart attack tomorrow. It happens. And making sure that you have something in place for your kid for the rest of their life is at least if that does happen, they're okay. You can either, with some companies, take out the death benefit to help with medical costs and bills, or at least make sure they can get more to cover those if that is the issue. If they're going to need more in life, that they at least can get it without any complications there. So, yes, kids need life insurance.
Everybody.
Everybody needs life insurance.
Was it the Hobbit or the Troll?
The Hermit inside of Mount Washington.
All right, Joanna D. from Bethel Park, and if you watched last episode, she is apparently a big fan because she wrote in last time too. But she said, why should I buy whole life insurance when term is so much cheaper? And my question back to you is, what is your need? Are you just trying to cover your mortgage? If that's the case, then term may be all that you need. But that's not going to leave anything. I mean, if you're just covering the mortgage, that's not going to leave anything for your burial expenses and for your spouse. If you're the main breadwinner, I mean, that could be a huge blow. If you have kids at home, all of those things are a factor. So if you're just trying to cover just your mortgage or just burial expenses, a term policy that might satisfy your need. But if you're interested in the aspect of building cash value, potentially being able to borrow against your policy, having something that's going to be in place until you die rather than a fixed term, those are things that are important. And the younger you are when you buy it, the closer they're going to be in price. So a term policy may not be much less than a whole life policy if you're a 22-year-old with great health and not a huge need. So there's a reason to buy both of them. There's not, I can't just tell you to buy just buy term because it's cheaper. I mean, that may not be what your need is. So that's again something to sit down and have an analysis done and come to that decision. But it really depends on what your purpose for the policy is, and from there you can determine if you really want to go with term or if you want to do a whole life. Who else is writing in?
I don't want to mess up names. But another question.
Clipper again.
Clipper, no. Another question I got is, what are the different types of life insurance? So we kind of went over them. You have two basic ones. Throughout there, different companies may have little variations, but two basic every company has is term and whole. Term, again, it's a fixed payment over a fixed amount of time. Then coverage is gone. Unless you convert it, well, then the payments go up. And then whole, there's tons of different options that you can pay. Walt went through them before. I'm not going to list them again. There's so much more, but it's permanent. It is there for the rest of your life. It cannot go away. And again, those are good for funeral costs, legacy, estate taxes, anything that's going to be left behind, period, whether it's in 10 years, 20 years, or 60 down the road. That's all I got.
That's all you've got?
Yep.
All right. I've only got one more.
Okay.
Dan B. from Pittsburgh wrote, and this question, this kind of bothered me when I read this. When someone is given a rate that is too high, why can't the insurance company come back later or come back with a lower face amount or death benefit?
What?
It made me upset because they can. We absolutely can. If you're dealing with someone and they tell you that you can have $250,000 coverage or no deal, take no deal and run away. Run away. Typically, an insurance company has a minimum amount of insurance that you can buy. $15,000. You'll see some policies that are just funeral expense policies that are $5,000 or $10,000. But most insurance companies that write mostly life insurance, they'll have a minimum that's $15,000 or $20,000. But you go up in increments from that. So to just tell you that you can only buy $250,000 and this is your rate, I can tell you right now, I had an exchange actually on social media with Dan about this because it concerned me so much. And he was offered one whole life policy and one very expensive term policy, and it was take it or leave it. I've never seen that before. Honestly, I've never ever seen a company do it that way, and it shouldn't be happening. So, Dan, I would tell you to look for someone that has your best interest in mind, and pick what you want. I mean, you're going to have a needs analysis done. I mean, that's step number one. But from there, if I tell you that you need $250,000 of life insurance, that doesn't mean that that's what you have to buy right now. If you can only afford to do $25,000 or $50,000, getting something in place is just a building block, and you can go from there. But you should never be forced to buy any particular amount for any reason. So I don't think that person or that website maybe had your best interest in mind. Because there are a plethora of options for payments. I mean, you can pretty much tailor your policy around what your budget is. So there's no reason to just accept just one face amount, take it or leave it. So I hope that answers your question. I know that we talked online, so I know you're in better hands now.
Hopefully.
But for anybody facing that situation, there's no one size fits all, and you should not deal with anyone that is just going to give you one option and offer you nothing else. Because there's so many insurance companies, and there's so many people out there that do this because they're in it to help people, and that's who you want to deal with. You don't want to deal with somebody that's just looking for a commission check, or just trying to sell X number of policies a month. I mean, most people are good judges of character, so deal with somebody that you feel comfortable dealing with and that seems to be working with you and is giving you options, because I can promise you there are many, many, many options for life insurance.
Mm-hmm. Absolutely.
All right.
Okay.
All right. We had plenty of questions over the last few weeks over social media, so we tried to work as many of them into our talking points as possible, and then we had a few that we just didn't work in. But we still want questions from you guys. We appreciate all the ones that we've gotten, and we want to thank you so much for watching and writing in. Our next episode is going to be on auto insurance, particularly about teen drivers and distracted driving. I've been reading articles recently about texting and driving and distracted driving, and it really, I have teenagers, so it really struck a chord with me. So if you have any questions in the meantime on that subject, please send them to us on Twitter. You can check out you can send them on Gmail, check out our Facebook, but just get them to us, and we'll do our best to answer them. If it's not something we can do on air, we'll definitely get in touch with you via email. We're on Facebook, we're Know the Risk 101. On Twitter, we are at Know the Risk 101. Gmail is knowtherisk101@gmail.com. And then the BPTV YouTube channel hosts our videos. So that's all we've got for you this week. Thanks for watching, and we'll see you in a few.
Bye.